Welcome to the deep dive. The final hours of 2025, they haven't just been about flipping a calendar.
Not at all.
They've really marked a seminal moment in the digital asset class. And if you've been tracking the daily intelligence brief, you can feel the air shifting.
Yeah, you really can.
We're moving, I think, decisively from the purely speculative phase, where narrative was king, into what we're now calling the deployment phase.
And that's where we saw this great bifurcation in institutional conviction really crystallize.
Right.
Exactly. This bifurcation, it's the critical signal for you to watch. It's a clear split. Some institutions are doubling down, aggressively expanding, while others are quietly stepping back.
So our mission for this deep dive is to pull out those core signals.
The three core signals, yeah. First, that violent reversal of Bitcoin selling pressure we just saw. We have to understand that. Second, map out the regulatory colonization of altcoins by the big players.
And the third?
And finally, we have to analyze how the fundamental economics of blockchain, especially around fees, are being completely rewritten.
Okay, let's jump right in with that Bitcoin pivot, because the action was, well, it was sudden and absolute.
It really was.
For the past week, the market felt like it was suffocating. It was this classic holiday liquidity void mixed with, defensive year-end tax loss harvesting.
A combination that just crushes prices.
It really suppressed everything and made more selling feel inevitable.
It felt like capitulation was coming, but it turned out to be just calendar-driven noise. The real countersignal emerged in what some analysts are calling the turnaround Tuesday phenomenon.
Okay.
We had just gone through this brutal 7-day streak. Over $1 billion in outflows from the U.S. spot Bitcoin ETFs.
$1 billion. So the big question was, had the institutional thesis broken? Was that it?
And the answer was a resounding no. It came as a massive, coordinated snapback. U.S. spot ETFs recorded a net inflow of $355 million on December 30th alone.
Wow.
That one-day inflow just violently reversed the entire week's punishing sell-off. The real story, the important part, is where that money came from.
Right, the details matter.
That's the key context. BlackRock's IBIT led the charge, absorbing a staggering $143.8 million of that inflow.
That specific number is critical.
It is, because it signals that what we call sovereign-grade structural capital, the long-term, non-emotional money, is back in accumulation mode. They just used that year-end selling as a discount window.
And it wasn't just BlackRock, was it?
No. Even Grayscale, the high-fee incumbent that's been bleeding assets for months, it actually posted positive flows.
Really? How much?
Only about $4.28 million, but the point is, it was positive. They basically hit the brakes on the outflows, even if just for a day.
That stabilization is important.
It is. Now, if you look at the charts, the price action confirmed all this buying pressure. Bitcoin successfully defended a critical support level.
We're talking about the golden pocket, right? The 0.618 fib retracement right around that $87,700 low.
Exactly. And for anyone less familiar with the technicals, just think of these Fibonacci levels as predictable gravity wells in the market. The 0.618, the golden pocket, it's kind of the last major line of defense. If price breaks convincingly below that, it suggests a much deeper, more painful correction is underway.
So the fact that it stopped right there and bounced hard.
It validates that this level was the line in the sand for high-conviction players. The technical signal couldn't have been clearer.
What was it shown?
On the 4-hour chart, you had a classic bullish divergence. Price made a lower low, which looks weak.
Right.
But the relative strength index, the RSI, it made a higher low. That disconnect is a textbook signal that selling momentum is totally exhausted.
So you combine the technical defense with the huge inflows, and it confirms the theory.
That the late December selling pressure was basically artificial.
Just calendar-driven noise. Smart money wasn't running scared. They were waiting.
Waiting for the tax loss sellers to finish and then stepping in to front-run the January effect rally everyone anticipates. They bought the liquidity void.
Securing their positions for the start of this deployment phase.
Precisely. And that takes us straight to that great institutional bifurcation, which shows where that capital is looking now, beyond just Bitcoin.
And this is where it gets really interesting. We're seeing this clear split, institutional aggression on one side and corporate capitulation on the other.
A huge divergence.
On the aggression front, you have this shock and awe maneuver from Bitwise Asset Management, Right before year-end, they submitted registration statements for 11 new single-token strategy ETFs.
In a single blast. And what's fascinating here is the strategic breadth of it. They're not just picking one or two winners.
No, it looks like they're trying to colonize the entire Web3 tech stack.
That's a great way to put it. You've got DeFi pillars like Uniswap and Elv.
Yeah.
You have high-performance infrastructure like SUI. They even included decentralized AI with Bitensor, or TAO.
Which many call the Bitcoin of AI.
Right, because it's trying to build that decentralized market for machine learning.
But the one that really stood out, the most surprising inclusion, had to be Zcash.
Ah, yes.
Why do you call that the most audacious pick? Filing for a privacy token in this climate seems like you're just asking for trouble.
It's just absolutely audacious. Zcash sits right on the bleeding edge of regulatory ambiguity. Regulators, they traditionally hate anything that complicates anti-money laundering tracing.
So including it is a statement.
It's Bitwise signaling their intent to push the boundaries of what's considered acceptable for institutional exposure. It's a calculated bet on managing that risk profile.
And they're not filing for pure spot ETFs here. They're using a strategy structure.
Correct.
This filing for 11 at once suggests they're just hedging their bets, maybe not convicted in any single one.
That's a sharp question. I think it's less about hedging conviction and more about regulatory arbitrage. That strategy structure lets them hold up to 60% in the spot token and the other 40% in derivatives or other ETPs.
So it diversifies the risk.
Both technical and, more importantly, regulatory risk. By throwing 11 filings at the wall, they're positioning themselves to be the vanguard of altcoins. They're ready to launch whichever one the SEC signals is palatable first.
And that conviction is spreading. Grayscale filed separately for an S1 to convert its Bitensor trust into a pure spot ETF.
Ticker GTAO. They see TAO as a premier asset for institutional AI exposure. It tells you the narrative has matured.
It's not just Bitcoin versus everything else anymore.
No, it's shifting to Bitcoin Core plus strategic satellites. But the other side of this bifurcation is the corporate retreat, which is, in its own way, a necessary cleansing.
Right, Prenetics Global, the health sciences firm, they just announced they're completely stopping their Bitcoin acquisition program.
To refocus on their core brand, IM8, the one backed by David Beckham.
And the timing is what makes this a perfect case study.
It's everything. They stopped buying on December 4th,
Right.
right as the correction started. They're holding their 510 BTC, but the buying's over.
So this signals they weren't a structural accumulator, they were a momentum player.
They bought the hype and then retreated at the first sign of real volatility. This is what we call the exit of the weak corporate hands.
Which is actually healthy for the market, right? It purifies the holder base, gets it back to the structural players.
Precisely. Volatility scares away the tourists and leaves the builders. And you can contrast that retreat with the miners. Look at Riot Platforms. They just signed a massive new $500 million at the market sales agreement.
So they're using shareholder dilution, selling new shares to raise cash for expansion.
It's an aggressive capitalization arbitrage bet. They are betting that future Bitcoin appreciation and their own efficiency gains will wildly outpace the cost of that capital.
A pure high conviction bet.
You see tourists leaving and builders doubling down. That's the bifurcation.
That's a perfect transition from capital strategy to economic reality, because beyond the capital flows, the actual economics of the blockchain space are being structurally rewritten.
They really are.
The most surprising data point of the year-end has to be that Solana, or SOL, generated about $1.5 billion in revenue in 2025.
Officially surpassing Ethereum in fee generation.
Which is huge.
It is huge. When we say the economic structure is being rewritten, this is what we mean. This validates Solana's whole high-volume, low-fee model.
Which was driven by that meme coin supercycle.
Exactly. Driven by velocity and sheer user activity. Solana proved a network can be sustainable through throughput, not just high fees per transaction.
So if I'm following, Ethereum's own success is now cannibalizing its revenue. It pushed so much volume to its layer 2s.
That those L2s are now starving the layer 1 mainnet of fees.
So the main bank vault is empty because everyone is using the local branches.
That's the dilemma perfectly. And it directly challenges that long-held ultrasound money thesis for ETH, which relies on high fees burning ETH to keep it deflationary.
The cash register is moving elsewhere.
It is. And speaking of high-speed rails, Tether is making a massive strategic bet on this exact dynamic.
Right. They led an $8 million Series A for a company called Speed.
And Speed is critical because it uses the Bitcoin Lightning Network to settle stablecoin transactions USDT on Bitcoin's L2.
So connecting the dots.
Speed is reportedly processing over $1.5 billion in annualized volume already. This investment is tether backing the lightning as a rail thesis for transferring stable value. They're making sure their product works where it's fastest and cheapest.
So they're positioning themselves to dominate not just as a stablecoin, but as the stablecoin layer on Bitcoin's L2 rails. That's a serious power move.
A huge power move.
Now let's shift gears to the sobering reality that comes with this deployment phase. The ecosystem is still carrying this massive, persistent security debt. The Slowmist 2025 security report found the industry lost approximately $2.935 billion to security incidents last year. It's just an eye-watering figure.
A colossal number. And what's important is the trend shift. The number of incidents actually went down.
But the value loss went up.
By a staggering 46%. Attackers are getting more sophisticated. They're targeting bigger honeypots.
And despite the narrative that DeFi is the Wild West, centralized finance, CeFi, accounted for the bulk of the losses.
About $1.8 billion, driven largely by that massive Bybit hack. It just confirms that centralized custodians remain a huge single point of failure.
And the problem isn't just digital. The FBI reported a surge in losses from crypto ATM scams to $333 million in 2025.
And this is really painful because it's driven by fraudsters targeting elderly, more vulnerable victims.
So we have to anticipate this is going to trigger much stricter KYC and AML enforcement on physical kiosks this year.
Almost certainly. The regulators will have to crack down. But beyond security risks, we're also seeing geopolitical risks flaring up around stablecoin policy. This is about national security now.
Coinbase put out a very stark warning. They said the U.S. ban on interest-bearing stablecoins under the Genius Act is a national security threat. Why such extreme language?
It's entirely because of what the People's Bank of China just did. The PBOC announced that their digital yuan, the ECN1, will start paying interest on January 1st, 2026.
Okay, so that sets up a catastrophic policy divergence. If the U.S. forces its own regulated stablecoins to yield zero.
While the Chinese sovereign digital currency yields, say, 2 or 3%.
What happens?
Global capital-seeking risk-free return will migrate. It creates a powerful incentive for investors, businesses, even foreign governments, to move trillions from 0% yield USD stablecoins into the ECNY.
It directly threatens the U.S. dollar's dominance in the digital economy.
And that's exactly the leverage Coinbase is using to lobby lawmakers. If they can pass through yield from their treasury reserves to holders, they lock in the dollar's dominance on the blockchain rails. This is currency warfare.
The ultimate fight for the rails of the future financial system.
It is.
So what does this all synthesize into? We've seen the market shed its year-end lethargy, pivot to a high-velocity start for 2026. The theme is clear. A rotation from Bitcoin only
to Bitcoin Core plus strategic satellites. Precisely the kind of assets Bitwise is targeting.
The deployment phase is about infrastructure, utility, and allocation, not just speculative price.
Exactly. And we've seen the swift exit of corporate tourists like Prenetics because of volatility. And at the same time, we've seen $2.9 billion lost to security vulnerabilities.
Which brings us to a final, crucial question.
It does. A high-stakes question for you to consider as we enter 2026. Does the lack of corporate conviction, that volatility-sensitive tourism, or does the persistent institutional fear of custody debt, highlighted by those massive security losses, pose the greater long-term risk to mass adoption?
A question that weighs heavily on the viability of the whole asset class. Something to think about as the calendar flips and the real deployments begin.